Welcome, everyone. I'm Jen Rogers. Thanks so much for watching. Today, we're talking about municipal bonds and if now is the time for investors to consider adding them to their portfolio. Joining us here today are Nuveen's head of municipals, Dan Close, and Nuveen's chief investment officer, Sarah Malik. Thank you both so much for being here. And we are going to be diving into munis. But Sarah, I got to just start at 30,000 feet and help us with where we are right now. What FAs should be thinking about for the economy and the markets for the balance of 2024.
Sure. Thanks for having me. What we're thinking about is three things: the economy, Fed, and inflation. So first, just starting with the economy, which has been strong this year and last year. Where is it going from here? We have started to see some mixed manufacturing data. Employment markets even are showing some signs of moderating. But the good news is the U.S. economy remains strong, and that's a positive across the board for states and the federal government. Let's move on to the Fed. What are they doing? We came into this year expecting up to 7 rate cuts, and those rate cuts have slowly been getting priced out of the market. Where will we go from here? Our view has always been no more than 3 rate cuts this year. I think I would even take the under on that at this point. I think the reason we're going to have less rate cuts than we originally hoped for at the beginning of this year is because of that sticky inflation. Late in 2023, inflation had started to moderate somewhat quickly. Coming into 2024, inflation started to reaccelerate. That was because people kept spending on services and experiences, and even that goods inflation that was supposed to unwind after the pandemic when supply chains opened up, that moderation even started to slow. So it's those three things that we're worried about going forward. As for the equity markets, they've had a nice rally year to date. I think it's, what is going to be our next catalyst from here? I'd like to see inflation start to moderate at a faster rate, and maybe some of these Fed rate cuts get priced back into the markets.
So, Dan, Sarah really set this out nicely for us in terms of what we're looking at. But what does it mean for the work that you do, and particularly for munis? Because do they work in any environment? How do you take what you just said and apply it to people trying to make decisions on when to get in?
Yeah, and thank you so much, Jen, for hosting today. I mean, we're seeing some very similar dynamics in the municipal market as to what Sarah had mentioned, and also some very unique characteristics on the muni market. First, and on a similar path, investors are really being paid to wait. There's income for the first time in fixed income. Tax-exempt income is very attractive when you compare it to just about anything else in the fixed income marketplace. If you consider a high quality AA- municipal portfolio in the intermediate part of the curve, it's yielding right now more than 6%. Nuveen's Muni Interval Fund, NMSSX, has more than 10% yield on a taxable equivalent basis. So, I take a look at the entire tax-exempt muni yield curve. It's yielding more than inflation right now, and this is the highest real levels of yield we've had in more than 10 years. But I guess more unique to the municipal market is just how good credit quality is right now. This is the best credit quality we've seen in more than 40 years. Rating agencies recognize this with their 4-to-1 upgrade ratio over the last 3 years. We're seeing collections 25% higher than previous peaks in 2020. And we're also seeing a record amount of state and local governments having rainy day funds. I think also unique to municipals and how we apply it is really the technical side. Consider that for this year, and it's going to be the third year in a row, that we're going to have more bonds called, more bonds matured, more bonds sink than new issue paper. And what that means for municipals is it's very scarce to have municipals. The municipal market has grown less than 5% since 2009, compared to more than 250% for the Treasury market. So how we're applying it in our marketplace right now is really asking investors to be patient, to know that they're getting very high levels of income, and we actually have income in fixed income for the first time in a very long time.
It is really interesting when you look at that landscape. Sarah, you set out that the Fed is really one piece of the puzzle. You had 3 points. And I want to dive in a little bit more on the Fed and forecasting rates, because as you're hunting for yield, it's an incredibly important part of the fixed income puzzle. So what are just the key points in there to be really paying attention to? As you said, you're taking the under right now on how many rate hikes we're looking at.
Sure. Well, the Fed's been very clear. They do not want to start cutting rates until inflation hits their target, which is 2%. And we are not near that yet. We're running at inflation still about 3+% levels. So first of all, I'm concerned inflation may not hit 2% in 2024. It may take till 2025. What is the Fed watching in order to determine when inflation may become less sticky? Well, first is wage inflation, and we've seen employment numbers remain very strong. Services spending, services inflation has also continued. Those are areas that need to moderate somewhat. The Fed also wants to see broader disinflation, so not just some of this unwind. I talked about goods spending has unwound a bit, but not unwound as much as we'd like. The Fed wants to see broader disinflation across the board. Otherwise, the Fed risks losing credibility because they could cut rates too soon, and the economy could then heat up again, and inflation could become even more of a problem, and that would be an issue for the Fed. So that's what I think they're watching. In an election year, the Fed tends to do less rather than more, which is another reason that I think as this year goes on, the Fed is less likely to start aggressively cutting rates, and that's why we've been in the 3 rate cuts or below camp for this year consistently.
Dan, I mean, I guess I'm so used to rates here and used to hikes. I forgot, like we're waiting for cuts, right? Everyone is waiting. What happens though if the Fed does nothing? Like, where do you look for yield? Does that change what you are expecting? I mean, what does it mean for munis?
Yeah, and certainly our base case is, what Sarah had articulated, that, the Fed is going to be patient. They're going to wait for data to come their way. And for a municipal investor, just again, highlighting the income that is available. So even if the Fed does nothing, we anticipate that muni investors are going to have a very, very good year. Consider for the first quarter, we had 10-year treasuries back up 35 basis points or so, and municipals were able to post a relatively flat return. So I think if we see nothing from the Fed, we could still have a great total return profile for investors. And if we do get even 1, perhaps 2 rate cuts for 2024, if inflation comes in softer, if employment rolls over, we do have that potential for capital appreciation. And then all of a sudden you go from earning that 6% tax equivalent income to something that might be considerably higher. And we got a very, very small whiff of that in the fourth quarter, with November, December being up more than 8% for our marketplace. So it's super content right now to just have the income component. But if there is some capital appreciation and the Fed does go down a different path, we certainly think that would be beneficial for munis.
Sarah, you make a really interesting point. It is an election year, unless you've been living under a rock. Everyone knows that. The Fed, as you said, tends not to do that much. But what does it mean for the economy and for the market overall as well? What should investors be thinking about?
Sure. Well, the good news on an election year is it tends to be positive for the markets. Markets tend to go up about 10, 11% in an election year. So that's the great news. Now, this election year is special. We have a lot of countries going to the polls, 77 countries, and 60% of GDP is going to the polls this year. We also have some nuances to the election that we may not have seen in the past. Misinformation, the impact of artificial intelligence, that could increase noise around the election years, which tend to be more volatile. I mentioned the Fed tends to do less rather than more during an election year. So that's why when I look at cuts, I think of, summer to fall, maybe you see 1 cut. And if you don't see it by then, you may have to wait till December to get 25 or 50 basis points of rate reductions by the Fed, because I think they'll hold right around the election. Areas that are important during election years, healthcare tends to lag because of regulations. Infrastructure could be a hot issue this year as we bring more of our manufacturing home and we practice more nearshoring. International issues are going to be important. And then let's not forget that high level of U.S. debt and what that means as rates stay high. I think that's going to be a continued issue around the election and after.
So, Dan, last question for you, also on the election, because for munis, taxes are so important, right? Like that is a key to figuring out how good they are for you. So what about any looming tax rate changes? Like, how should financial advisors approach thinking about that?
Yeah, I guess 2 broad points on taxes and the election. The first is, no matter who wins, if we have mixed government, a red wave, a blue wave, we're still going to see very, very broad support for municipals. Consider during COVID, 5 rounds of COVID finance. Every single time there was a round of COVID finance, it touched state and local governments. And this is why you have record balance sheets, record rainy day funds for state and local governments. So regardless of the outcome, we think there's going to be very broad local support for municipals. And we think that's going to be a very positive outcome. I think the one thing that we're looking at right now the closest is the Tax Cut and Jobs Act, and that's supposed to sunset in 2025. I don't think I'm going out too much on a limb to say that we'll probably have some form of divided government. And if the Tax Cut and Jobs Act is not extended, if the tax code is not gone and in some way changed, you're going to automatically have the highest tax bracket going from 37 to 39.6%. So under the scenario, or I think the likely scenario that we do have divided government, I think there's less of a chance to get a comprehensive change to the tax code, and automatically you do have an increase in taxes. And that just makes the muni exemption that much more worthwhile. That makes the muni exemption worth more because you're able to shield more of your income from taxes. So I think in this election, no matter how it does turn, it should be somewhat favorable for municipals because we do view the prospect of higher taxes to be very high. And with higher taxes, we usually see a greater value of the tax exemption, which should be beneficial for the municipal market.
That's all the time we have. Really fascinating stuff. Thank you so much. Thanks to Nuveen and Dan and Sarah and to everyone watching.
Thank you.
Thank you.